The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A stock rally flips to a stock sell-off as market euphoria fatigues 1 week post-election. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. and the S&P 500 snapping a 5-day win streak. Materials and utilities leading the decline, although the decline is pretty limited right now. The bond market comes back from a 3-day weekend with a resumption of the sell-off. You're seeing higher yields. The 10-year now above 4.4% once again. Higher yields, higher dollar. The Bloomberg Dollar Index gaining about 0.5%. It's actually at a 2-year high. However, you still see Bitcoin edging higher. It got within spitting distance of $90,000, Romaine.
Yeah, the Trump trade's still in effect here, but with the major indices all coming close to overbought conditions on Monday, it's reasonable to see a bit of a pullback on this Tuesday. Chris Montague and his strategist team over at Citi said just as much in a note yesterday, citing the high likelihood of profit taking following a massive post-election rally that pushed investor exposure to U.S. stocks to the highest since 2013. Now, while the stock rally is on pause for today, the dollar rally does barrel on. The Bloomberg Dollar Spot Index up almost 2% since Election Day, the biggest 5-day gain since late 2022. And JPMorgan strategist led by Mira Chandan says that the rally, it ain't over. Expect an additional 7% run over the next few months, she says, as the Trump administration and its likely protectionist policies change the FX calculus.
We've got more to go. These things can overshoot. I don't think we'll beat the highs that we saw in 2022 in Eurodollar. I doubt we'll make a new high in dollar yen. But right now we are definitely going to go up a little bit further.
Now, whether you're long dollar, long stocks, short bonds, it's all really academic to a lot of Wall Street traders out there who are looking at all the market activity and really licking their lips. So too are investment bankers and asset managers, all who stand to reap some major year-end bonuses, double-digit increases on those annual incentive payments. That's according to Johnson Associates. And that includes as much as a 12% bump for those wealth managers, 20% for equity traders, and a 35% increase for debt underwriters. Scarlett, nice work if you can get it.
Absolutely, and it's all that activity piling up. Of course, things can always change in the final weeks of the year, but so far, we've seen exuberance across risk assets like stocks, as well as some more speculative areas. Take a look at Bitcoin, of course, in white, more than doubling in value this year. SPACs, which is in yellow, on the rebound as well. And in blue, you've got tech companies that are not profitable. Not a problem. That group also getting a lift at the end of 2024. Aside from Bitcoin, we are nowhere near the peak that we saw in early 2021 when there was a ton of liquidity, but Romaine, you'll definitely see a pickup here in late 2024.
Absolutely. As we kick you off to the close, let's bring Anastasia Amoroso into the conversation, Chief Investment Strategist over at iCapital, who joins us here in Studio 2. No doubt about it, Anastasia, there's been a lot of exuberance over the last 5 or 6 sessions here. But is that exuberance, is it sustainable? And more importantly, when you look backwards, was there any irrationality to it?
No, I don't think so. I do think it's justified. And the exuberance is not only about what's going to happen in the next couple of months, but it's really what is the regime for the next couple of years, at least going into the next midterm election. And the regime is likely to be pro-growth. It's likely to be pro-tax, lower taxes, and also pro-deregulation. So that's what the exuberance is about. And I think that's justified. Is it sustained? I mean, clearly, I think we need to give a little bit of back near term. I will say, I think looking past today, if you think about the seasonality, it is on an investor side. So I personally would still lean into the seasonality, which is positive going into year end. But here's one word of caution that I would add to it is the first act from the new administration is not likely to be on taxes. It's not likely to be, well, maybe it's a little bit on deregulation, but it's likely to be on tariffs. And that's what the markets really need to pay close attention to and position accordingly.
Well, on the point of tariffs, I mean, some people are looking at that as a potential upside for certain stocks. The idea that you have certain small and mid-cap companies that might have been dealing with foreign competitors, and the idea is that an increase in tariffs, in theory, would actually help their business here. Do you see an upside to those tariffs?
Yes.
I mean, I'm talking strictly from an investment standpoint.
Yeah, that's exactly what I mean when I say you need to position selectively and you need to position accordingly. It is going to be a pro-domestically oriented stocks kind of a market environment. So we're starting to see, by the way, this divergence between the beneficiaries of onshoring, the beneficiaries of having a high domestic share of revenues, and we're starting to see this dichotomy with those that would benefit or would be hurt by higher tariff environment. So that's already starting to happen. But I think, again, you lean into that. And so small caps are giving back some of their ground today. But I think that's exactly the sector that is poised to benefit from the new policies.
So to follow on that, you say seasonality is definitely going to be a factor. You want to lean into that. I look at the S&P 500, and it is up about 25% this year. And if you look at how its annual gains, last year, 24% gain. In 2021, 27% gain. How much juice is left in some of these gains? I mean, even with the seasonality tailwind.
Yeah. Well, if you look at strictly the fair value of stocks, we're there. 6,000 on the S&P. You know, if you take next year's worth of earnings and if you apply a 20 times multiple, you know, we're roughly there. But it is possible, I think, to overshoot that. And the reason I say that is because the buyback authorizations are at record highs and the buyback window is wide open now. And now the volatility has collapsed. It's possible that some of the systematic investors will start to lever back up. And I do think that there is this chase in the market right now, which is you want to be in for the next administration set of policies. So I do think we may overshoot. But I guess, Scarlett, to extend that further, you know, if we overshoot, are we then so far ahead of our skis? Probably not, because if I think about 2026 set of earnings expectations, we're looking at $303 on the S&P. And if you apply 22 times multiple to that, you are looking to about 6,700 on the S&P at some point next year.
You're already out to 2026? Wow.
That's what the markets are going to do at some point next year. Yes.
Markets are forward discounting mechanisms, right?
That's right.
According to a Bank of America survey, the share fund managers who are overweight in U.S. stocks have tripled to a net 29%. What about foreign investors in U.S. assets? Are they underweight in U.S. assets?
Well, it's a really interesting question, Scarlett. I recently came back from Asia, and speaking to a lot of clients out in Asia, there, as with any market, there's a sense of domestic bias. You know, you invest in what is around you, but unfortunately for Asia investors in particular, it's been a really tough place to be locally. So yes, there is this sense of needing to look to the United States, and by the way, not only to public equities, but also looking at private markets as well. Private credit is definitely picked up in conversations. So yes, I think a lot of investors internationally are looking to the U.S.
What about U.S. investors who might be looking internationally? I know this Trump trade is definitely very driven by the prospects of domestic good times here. But, you know, a lot of folks want to be diversified, geographically speaking. Do you find anything attractive outside of the U.S.?
I think at some point there will be a buying opportunity in international investments. But I think what comes first is the possibility for a drawdown. And, you know, to go back to the tariff discussion, probably the first set of tariffs that are picked up, at least in conversations, is going to be a tariff on China. Probably not far behind that is going to be the discussion of tariffs on European Union vehicles. Remember, that was a policy that was being discussed back in the prior Trump administration. So I think that's going to be top of mind. So it's hard to, I don't want to be in front of that, but once that pullback does occur, I think that's an opportunity.
With regards to China, I can understand why some U.S. investors would avoid investing in Chinese stocks specifically. But is there an argument to be made to maybe be a little bit careful about U.S. companies that have large China exposure?
Yeah, I think that's right as well. And that's why I am a little bit more cautious on tech going into 2025, for example, because I do think that technology has a lot of exposure, not only to China, but to other international markets. And I think front and center is going to be a conversation about the semiconductor supply chains. And so any tech company that is going to get caught up in that, I think, is, you know, a candidate for a market pullback.
All right, Anastasia, got to leave it there. Anastasia Amoroso, Chief Investment Strategist at iCapital, kicking us off to the close here on this Tuesday afternoon. A focus on the Trump trade and President-elect poised to load up his cabinet with China hawks. We talk foreign relations with hedge fund veteran and founder Kyle Bass.
Plus, how Delta is helping take private jet company Wheels Up to a higher altitude. A discussion with Ed Bastian, CEO of Delta, and George Mattson, CEO of Wheels Up.
And third quarter results are still coming in hot. We sit down with the CEOs of two companies reporting after the bell. A conversation about AI with the CEO of SoundHound and a conversation about gaming with the CEO of Flutter. Stick with us. A lot more coming up here on the big program. This is The Close on Bloomberg.
season is here.
Third quarter earnings season, as we've been talking about, really in high gear.
Bloomberg is first to break the numbers.
We have some big earnings after the bell. Earnings from Caesars crossing the Bloomberg terminal.
Mondelez is reporting
Reddit, AMD, Snap.
Let's keep the conversation going.
With the smartest insights.
The bar keeps getting higher. 20% growth rate when your comps get tougher. How much can you beat and raise?
Continuing coverage on Bloomberg. Context changes everything.
activist investor Elliott taking aim at Honeywell, building a $5 billion plus position in the industrial giant, and on its wish list, a breakup. We're seeing shares of Honeywell moving higher on the news, up more than 4%. Joining us now with more is one of the reporters who broke the story, Bloomberg's Crystal C. So, Crystal, what Elliott is looking for is something that we've seen with other industrial companies, break up into smaller companies to unlock the value.
It's a very popular thesis amongst industrial conglomerate companies. And if you look at General Electric, they broke itself into three parts. Like DuPont had gone through multiple iteration of breakups. And this is Elliott coming to Honeywell saying, you're one of the last one that haven't broken up yourself. And it's probably better off that they break it up in two pieces, which is what Elliott is pitching today. They should break it into Elliott Aerospace and Elliott Automation, which is everything else.
Well, I guess it's a good question, though, because everyone's sort of comparing GE and some of that. Those weren't necessarily smooth transitions. I know GE looks like it might have actually stuck the landing on it. But some of those other transitions from conglomerate to whatever sort of disparate units has not been smooth. So how exactly does Elliott see this playing out?
And it's also not quick. It's always a multi-year process. And you're going through a lot of, picking out divisions, and then you're finding a new business head. So a lot of that will, if this happens, it will likely take multiple years. But it's not, I would be surprised if someone say that Honeywell never heard of this idea, right? A lot of investors, especially in the industrial space, have actually gone to companies saying probably pretty much the same thing. And I think Honeywell got the idea. They announced a more minor spin-off last month of their advanced materials business. So the idea is there. I think Elliott is just here.
And they've had a few divestitures over the last couple of years. It's not like they've just been sitting doing nothing.
Yeah, they also bought a couple of things. They bought things from Air Products. They bought things from Carrier. But it's if you're building out a portfolio, it's no longer in fashion. Like it's kind of swung the other way, where you should be selling, you should be simplifying, you should be unlocking value instead of empire building.
Yeah, diversification is definitely out for these industrial companies. We should note that a spokesperson for Honeywell said that the company welcomes investor feedback as it continues to execute a strategy of sustainable growth. So under the new Trump administration, we're going to see a pickup in M&A. That is kind of the consensus here as part of this less restrictive regulatory environment. Where does activism fit into that?
So that is definitely emboldening activists to push for more M&A thesis. In the past year or so, we're seeing a lot of operational changes, a lot of board refreshment, management change, and very few of them involve any sort of M&A. Not a lot of divestiture, not a lot of selling yourself outright. And now that there is a potential of interest rate coming back down even further, and regulatory scrutiny perhaps reducing a little bit, there is a little bit of let's get things started and let's see what we can do in the next 6 months.
Is it going to be like more folks than just Elliott involved in this? Because I feel like every activist story, it's like Elliott is the first word in the headline.
They have done more than a dozen campaigns this year, so they're definitely driving a lot of activity.
What's their bonus going to look like at the end of this year?
Hopefully good.
Crystal C covers this all for us here at Bloomberg. A closer look here at the latest campaign by Elliott Scarlett, of course, to try to break up Honeywell. Not necessarily a novel concept, but one that they think, if you look at what happened with General Electric, UTX, and a few others, think it could be replicated with success.
Yeah, just not so long ago, 10 years ago, maybe that's a long time ago for everyone else, all the talk was, oh no, you got to be defensive and you got to have all these different businesses to shield you from when one part of the industrial economy doesn't do as well. I know Sonali Bastian spoke with Citigroup CEO Jane Fraser, who says it is game on for deals in the U.S. right now.
Yeah, well, we'll see. I mean, we still got a long way to go here, and it'll be interesting to see whether good deals get done.
Bankers get paid good deals, bad deals anyway.
It's a nice lifestyle, Scarlett. Them and the
That's
lawyers.
the second time you've said that.
Them and the lawyers. Hate them all. All right, when we come back after the break here, we're going to talk about some big earnings that we got out of Home Depot. Actually seeing a little bit of a pickup in demand for seasonal items and supplies last quarter. We're going to recap the home improvement company's latest quarterly report. That's coming up in our top calls, and it's up next, right here on Bloomberg. All right, let's get a view from the sell side. It's our top calls. The big movers on the back of analyst recommendations, and we're going to start today with Twilio. Wells Fargo upgrading to overweight, characterizing the maker of application programming interfaces as a pick and shovel derivative call on artificial intelligence. The analyst Michael Turin seeing strong potential from generative AI that can spur new tech developments and drive sustained growth for the company. He also lifts that price target to 120 from 80. The shares getting a lift of about 3% on the day. Next up, cruise line operator Viking Holdings, Morgan Stanley upgrading to overweight, boosting the price target all the way from 37 to a street high $49 a share. The analyst saying demand for cruises still robust and a falling oil price also helping matters. While the shares have rallied 40% over the past 3 months, that lags most of its peers by at least half, and that results in an attractive relative valuation, says the analyst. Those shares up 3% on the day. And finally, Ross Stores, a cut to neutral over at Citi ahead of earnings next week. One of the main concerns comes from unfavorable weather patterns in California and Florida, two states that represent about 35% of Ross's store base. The other concern, uncertainty around a CEO transition from Barbara Rentler to James Conroy, who officially takes the helm in February. Those shares down 1% on the day, and those are some of our top calls. We do want to say on that topic of weather patterns and inclement weather patterns helping drive comp sales at Home Depot. The home improvement retailer reporting better than expected same-store sales numbers last quarter and raising its earnings guidance for the full year. Joining us right now is D.A. Davidson analyst Michael Baker. He has a buy rating on Depot. All right, Mike, let's get right to it here. When you go through the numbers from the last quarter, they weren't great. They weren't necessarily bad. What was your general assessment?
Well, they were a little bit better than expected, right, on both the top line and on the earnings line. So still negative, but less negative than expected, less negative than they have been the previous few quarters. In fact, the smallest negative comp in probably about 2 years or so. So, sort of bouncing along the bottom to even getting a little bit better and relative to expectations that surpassed the bar.
We're still talking about a forecast full year of comp sales being down 2.5%. I know that's not as bad as the previous forecast they gave here. When are you anticipating or when are you modeling a return to full year revenue growth?
Yeah, and that outlook includes down at about 2.5% in the fourth quarter as well. Currently, our model has same-store sales flattening out in the first quarter and then turning positive by the second quarter. So we're getting closer. Now, to be fair, if you asked me that a year ago, I would have thought we'd be there by now. But it has gotten pushed out a little bit. But we still think we're closer to the end of this negative comp run than the beginning for sure. And at some point in 2025, we're going to see positive comps. Comps were actually positive in October. That was helped a little bit by the hurricanes. But even if you adjust for that, the trends got better throughout the month.
Okay, so perhaps that's the beginning of better comparable sales. You mentioned weather, and I'm wondering whether Home Depot and to some extent Lowe's can optimize around weather events. The timing of these events are unpredictable, certainly, but it is a given, and the companies know that, and they're prepared to provide the products that consumers need. But is there anything more they can do?
I mean, they do have very sophisticated supply chains, so they can move products around depending on different weather patterns in different parts of the country. But generally speaking, I think these companies understand that sometimes the weather is going to cooperate, sometimes it won't. Over a period of time, it's going to normalize. And that's one of the things that we saw this quarter where, again, a better than expected third quarter. But the management team was very sort of fair and tempered on the fourth quarter outlook, acknowledging that the third quarter was helped not only by the hurricanes, but even if you adjust for that, they still beat. And that was because the weather outside of the hurricanes was really optimal. Nice, warm weather. People were outside doing projects. They're not expecting that to necessarily continue in the fourth quarter. They're not going to count on that. And that's why, despite the really strong, at least relative to estimates, third quarter, they did have a little bit of a more tempered fourth quarter outlook, acknowledging the fact that you can't always have optimal weather.
Okay, well, as we look for a continued improvement in same-store sales, what about the pro business that Home Depot acquired? What more are you looking for the company to do on that front?
Yeah, well, their pro business was positive for the first time in about 2 years this year. And a big part of that is what they call the complex pro. That's really the bigger pro. not one guy in a truck, but really big, sort of corporations. And that's who they're going after with this SRS acquisition. They've been going after that business prior to that. They actually have this Complex Pro initiative in 17 markets, and it's working very well. The SRS acquisition really just helped them along with that, sort of, gave them another toehold into some of those businesses, but is really keeping to that same strategy of attacking that larger Complex Pro. Very difficult business, but if they can get it right, there's a lot of market share there.
Well, this gets to this idea, though, too, about kind of the balance when we talk about the home improvement retailers, whether it's Home Depot or Lowe's, and kind of that balance between going after the rank and file consumer like you and me, rank and file homeowner, if you will, or more of the prosumer or the professionals overall. Do you find in the way you're modeling things, there is a healthy mix there that you would like to see implemented?
Yeah, well, they each go after all three of those segments, but to different extents. Home Depot is right now about 50% DIY, 50% pro. And again, some of that pro is now much more towards that larger pro business. Lowe's is about 75% DIY, 25% pro, and almost all that pro is the smaller pro, not the prosumer, as you call it, not the bigger pro. So a healthy mix of both. Home Depot has very high share in both the DIY and that smaller pro business. And so because of that, they've identified this larger pro as the next stage, if you will, of their growth. And again, it's been years in the making in terms of putting in the investments to go after that Complex Pro. Very difficult business. You have to have job lot quantity, on-site, on-job delivery, all kinds of complex things that they've been really implementing behind the scenes for the last few years, and it's starting to pay off. Those markets with that Complex Pro initiative were 2 to 3 percentage points better than the total markets.
With regards to the cycles of the housing market and the idea that we kind of missed out on the last sort of home buying season, if you will, last spring, which didn't really materialize, at least to historical levels. Do you anticipate that we're going to get back to a more normalcy in that home buying process? And how does that feed into Home Depot and earnings for Lowe's as well?
Yeah, we think at some point we will. It's hard to know exactly when rates came down. We saw a spike in mortgage refi activity and HELOC activity. Rates have come back up. That might slow it down a little bit. But at some point, I think consumers and homeowners or home buyers will get used to rates at about this level. And we do think existing home sales will start to pick up. Again, if you look at sort of, maximum, minimum over history, we are much closer to the minimum, to the low point in the existing home sales.
Right.
And if we simply revert back to the mean, we're going to be closer to 5 million homes turning over versus right now it's about 3.8 million annually.
All right, Mike Baker over at D.A. Davidson, thank you so much for his analysis on Home Depot. Romaine, I don't know if you saw the story about Stanley Black & Decker preparing for increased tariffs that, incoming President Trump has said he will slap on Chinese goods,
yeah.
And says it's going to raise prices.
Yeah.
That's exactly what a lot of economists had said these tariffs would do.
Yeah, I mean, this is kind of Econ 101, and I think a lot of people are going to find out the hard way exactly how the economy works. But good for Stanley Black & Decker for at least trying to get ahead of it.
Yeah, warning about it. All right, coming up, what China will think of a second Trump term. We'll talk with Kyle Bass of Hayman Capital Management. This is Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Scarlett Fu. And a week after Election Day, we finally see the S&P 500 declining for the first time in about 6 days.
Yeah, only about 0.2%. But I mean, you think about just how far this market had come just over the past 5 sessions since the election. And really, this was a rally that kind of started really a couple of days prior to that here. So you're talking about pretty significant gains in a very short period of time. Doesn't mean the rally's over, but certainly a lot of folks are maybe looking at some of their profits and saying, might as well take a few chips off.
Yeah, but there is that seasonal factor, and everyone's looking for the gains to continue through the year end, even with the S&P already up about 25% this year. All right, and of course, we're all keeping an eye on what's happening with the incoming Trump administration. As the president-elect fleshes out his cabinet picks, markets expect those responsible for managing relations with China to take a hawkish stance against Beijing. Former U.S. Trade Representative Robert Lighthizer and Linda McMahon, former head of of the Small Business Administration are in the running for the top job at Commerce. Meanwhile, Florida Senator Marco Rubio likely to be nominated as Secretary of State, according to people familiar with the matter.
Oh, he's back in the fold.
He is back in the fold. And there's also Congressman Mike Waltz as NSA, National Security Advisor as well. So joining us now for more on all of this is Kyle Bass. He is founder and CIO of Hayman Capital Management. Kyle, good to speak with you. I want to start by getting your reaction to these personnel decisions, elevating China hawks like Marco Rubio and Congressman Mike Waltz. It's very much a get tough on China message. Is it the right get tough on China message that the incoming administration is sending?
Yeah, look, first of all, pleasure to be here. When you describe everyone as a China hawk, I would just call them China realists. I mean, Xi Jinping has been telling you what he's going to do since 2017 in every public speech, every public appearance he's made, and truthfully, every meeting he's had with U.S. officials. So when we start realizing that China is not our friend, and if you read the Director of National Intelligence's annual threat assessment report to Congress, in no uncertain words do we say China is the largest threat to U.S. national security. So I think it's important to note that our leadership has done a poor job in explaining to the American public what kind of threat China actually presents. Now, I've worked closely with Marco Rubio and his staff over the years, and several of the other people that are being nominated here. And these people understand the enormity of the threat that China poses to the Western world and to the security of the United States. So again, whether you call them hawkish or realists, what we're doing here is we need to stop affording China these battlefield asymmetries that we're giving them. And we can go one by one, the asymmetries we've advanced. But Rubio is a very, very strong pick for Secretary of State. He will bring with him the gravitas. And I think the Democrats are really worried about Trump's stance on ending the Ukrainian war in one day by ceding advances to Putin. And if you know Rubio, I don't think that's going to happen. So I think we've got to be realizing that all of the bad guys are all together in fighting against the West, and putting Rubio in place, putting in Treasury Secretary. You guys started talking about the markets. Like the markets are factoring in Treasury Secretary Scott Bessent becoming
Kyle,
the next Secretary.
let me follow
Treasury.
up on that point. We're talking about the markets. What does this mean, these kinds of picks mean for Chinese assets? And how would you personally, your firm, express it beyond the Hong Kong dollar short that I believe you had last year?
Right. We have no other positions on other than that position. We've carried that position since 2017, just to be clear. Mm-hmm. If you invested in China 16 years ago in their largest equity index, the Shenzhen Shanghai 300, their GDP went up 505% in the last 16 years, and you've lost a third of your money being invested in their markets. Just imagine losing a third of your money in a nation that's grown its GDP 500%. When the U.S. has grown our GDP about 75%, and you're up 400% in your S&P 500 investments. Investing in China is a fool's errand. It is no one has ever made money in the long term investing in communism, and no one ever will. And so investing in China, again, is a horrible idea going forward.
But Kyle, I mean, you have to understand why people are interested in that. It isn't really any sort of ideology on communism versus capitalism. It's on, a billion people who are, at least in theory, seeing an increase in their wealth, an increase in their capacity to spend. And, look, if you're an investor, you're a global investor, you want to have some link to the world's second largest economy, don't you?
No. Romaine, I think that's, again, I think that's flawed thinking. I think that if you're investing in an economy with the architecture of the Chinese Communist Party and the Standing Committee, you don't have to do anything. I think that, yes, there are 1.3 billion people that are trying to be elevated from various levels of poverty to the middle class and the upper class. But again, if you've been invested long-term in China, you've lost a lot of money. Yeah. When you didn't have to discount communism, you didn't have to discount Xi Jinping, you didn't have to discount which business he decided was going to succeed or lose. You didn't have to discount any of those things in the United States, and you've done incredibly well. I just think as a fiduciary, you're breaching your fiduciary responsibilities if you make that investment.
Well, let's get to, I think, that kind of broader esoteric conversation about American exceptionalism. And I'm speaking strictly from the standpoint of financial markets and the returns that folks have had here. And as you know, every portfolio manager, at least the ones that went through a traditional sort of training in our schools here, was probably taught this idea about geographic diversification and the idea don't put all your eggs in one basket. But what I'm hearing from a lot more people, and I assume you're probably fall into the same camp, is that the U.S., or at least North America, is primarily the basket where you want to put all your eggs. Is that a mischaracterization?
No, it's not. I think it's right. And look, yes, are there exceptions? Are there other economies like Mexico, where now our largest trading partners are Mexico and Canada, no longer China? The U.S. is 4% of the world's population. Yeah. We are a quarter of the world's GDP, and we are 46% of the world's capital markets. Just think about that for a second. The world votes with its money, and it votes here. And I think that this is the place where your money is the safest. I also think that the new Trump administration is going to engage in a regulatory clean out, right? You're going to see a new head of the FTC. You should see mergers and acquisitions pick up right away. Yeah. You should see a new head of the SEC, a new head of the OCC, the FDIC. You're going to see the animalistic spirits released on our economy that have been withheld over the last 4 years.
Well, you've certainly already seen that in public markets over the last few days, as I think a lot of people anticipate those changes come January. Have you been in discussions at all with the Trump administration? Do you have any role, informal or otherwise?
I have no role at the moment, but I do know many of the people that are being chosen for, many of these positions, and they are people I admire, people that are friends of mine. And I think the single most important nomination for financial markets will be Secretary of the Treasury. And I think Scott Bessent is the odds-on favorite there. And I think that when people understand the way Scott thinks and his brilliance, and the markets are already factoring in Scott Bessent's opportunity here. And I think that when that day comes, it'll be a very positive day for markets.
Scuttlebutt is that he is the front runner. With regards to some of those other positions, particularly at the SEC, who do you want to see leading that agency?
I don't know who the front runner is for the SEC. I do think that, when we're talking about the people we're talking about for the CIA, for the Secretary of Defense, for Secretary of State and Rubio and others, we're starting to see really a fantastic lineup of people that have real depth in their understanding of this position. And I think that the belief was coming into this election that who would join a second Trump administration, given what happened to the first Trump administration with their legal problems. I think I am wildly impressed with who's stepping up and who's taking some of these seats. Jay Clayton, the former chair of the SEC, is likely to be the Attorney General. I think he is a fantastic pick for Attorney General. Whether it's Patel at the CIA or someone else, or whether it's Ratcliffe as Secretary of Defense, like all of these people will be phenomenal folks. And I think you have to realize, right, we have a ground war in Europe. We have Israel versus Iran, and we're about to have China, Taiwan. We better put together a cabinet that has gravitas. And I think Trump is putting that cabinet together.
Kyle, really appreciate your joining us. Kyle Bass is founder and CIO of Hayman Capital Management. And let's give you some breaking news here on Apple. It's going to launch an AI-powered smart home device as early as March as it tries to catch up with rivals in that market. This is a wall-mounted display that can control appliances, handle video conferencing, and use AI to navigate apps. The stock not moving right now.
All right, one stock that is moving is Shopify, having a phenomenal day, up more than 20%. It's our stock of the hour, and it's up next. Stick with us. This is The Close on Bloomberg. All right, let's take a look at our stock of the hour. We're watching shares of Shopify. The stock soaring today more than 20% after reporting third quarter results that beat estimates. And of course, that projection for strong sales growth going forward into the holiday season. Abigail Doolittle joining us right now to help us walk us through why we're seeing so much euphoria here around the stock. I mean, this is a stock that's been pretty volatile, but still 20% off of an earnings beat.
It is pretty impressive. Yeah. It's the best day actually for the stock going all the way back to 2015. And so it really has more so to do with the payment technology that they have and payment volumes as opposed to subscriptions to their set up your own store, your own shingle through Shopify. And the numbers are really pretty strong. So in the quarter that they just reported, free cash flow margins around 19%. They're expecting them to stay in that range for the fourth quarter. But it's the sales revenue for this current quarter that's really blowing people away. They're saying it's somewhere between mid to high 20s. The estimates for 24%. I saw one official estimate out there for 26%. But that's a strong tell on holiday season shopping.
So do you use the Shop Pay? You know, like if you go to a website now, sometimes like when you're going to the checkout to buy something, now the Shop Pay. But if you sign up for it, all you have to do is just click that button, and everything. It loads your address. Yes, a little dangerous though.
Well,
yeah, you spend more. That's the whole point. But it's frictionless. You don't need your credit card. You don't need anything.
Yeah, I'd rather input all the numbers because it gives me an opportunity to second guess myself about whether.
That's what they want, Scarlett.
But that button really is taking share, or it's doing better against PayPal and some of the other payment solutions.
Click on that. They got the PayPal. They got the Google one, and Amazon. I'm like, no, just give me Shop. Shop Pay is just easier.
I know they collect a lot of data.
That's not an advertisement for it. But I'm saying I've used it. PayPal, you have to go through more steps.
Yes.
And maybe it's more secure as a result. Who knows? But Shop Pay is easy.
It's frictionless, like you said.
I'm sure I'll get in trouble with all these other companies.
No. But I think it's fair to say that it's frictionless and it makes it simple for the consumer. Abigail, do we know what else they're planning to grow into? What other plans they have beyond, this Shop Now button?
Well, I think that the main thing is really just to keep
executing.
Yes, exactly. My awareness is to just keep these strong numbers going. The street's very positive in terms of saying it was a quote unquote hat trick. They had the growth, they had the margins, and then the GMV. TD Cowen is saying that shows that their e-commerce leadership. So I think it's a matter of just keeping the current situation going.
Frictionless payment. This has been my bugaboo even before we had e-commerce. Like, I always hate like when you go to a restaurant and you're done eating and it takes like 20 minutes for them to bring the bill and do that back. Just everything needs to be frictionless.
Look at someone.
That's what I want, Scarlett. That's what I want.
How did you start with Shop Pay?
How did I make it this far in life? I have no idea either.
But how did you start with Shop Pay?
I don't know. We have to go, Abigail.
Okay.
All right. Coming up.
That's a whole segment on its own.
We're going to take you to the close with Jason Pride, Chief of Investment Strategy and Research at Glenmede. This is The Close on Bloomberg.
The exuberance is not only about what's going to happen in the next couple of months, but it's really what is the regime for the next couple of years, at least going into the next midterm election. And the regime is likely to be pro-growth. It's likely to be pro-tax, lower taxes, and also pro-deregulation. So that's what the exuberance is about, and I think that's justified.
And that exuberance that we've seen over the past 5 sessions on pause here on this Tuesday afternoon. That was Anastasia Amoroso who kicked us off to the close just about 50 minutes ago with stocks, at least in aggregate, all red across the board today.
Yeah, and we're also seeing Tesla decline for the first time in 6 days as well. I know. The proxy for the Trump trade down about 6%.
Where is Elon Musk? He's just still at... Has he left Mar-a-Lago? He's just basically... Like, he lives there now, right?
Maybe, So he's been on phone calls with
California to Texas. Now he's just going to live there.
Yeah.
Okay.
He's busy.
Yeah, he's busy.
We'll see how long he's busy for.
What world leader is he calling next? Get ready for 4 years.
Maybe he could broker something between Trump and Xi Jinping. The Russell 2000 also declining, giving back almost all of yesterday's gain, which, as you noted, took it just shy of a record close, but backing away from that.
Well, this is the move that I'm more interested in. I mean, it's one thing for the rally to be put on pause, but to see all of the gains from yesterday on the Russell kind of grab back today, like what's that all about?
Yeah, I know. With everyone saying that's the part of the market that's going to have legs, right?
Domestic-oriented stocks are going to probably benefit most, right, from Trump policies.
See, but that's inconsistent with the whole idea that bonds are selling off because of concerns about what the tariffs will do to inflation, because these small-cap companies are expected to benefit from all the tariffs as well.
And we should point out, of course, that bond sell-off has resumed. Markets were closed. The bond market was closed yesterday for the Veterans Day holiday. Now open here and now seeing about a 12 basis point jump in your 10 and 5-year yields. Jason Pride joining us right now, Chief of Investment Strategy and Research over at Glenmede. Jason, let's talk about the exuberance in this market and really the idea, and I think this is to the point that Anastasia made to kick us off here, the idea that the exuberance we've seen over the past 5 days is probably going to continue well into 2025 once we actually start to see some of those Trump policies in place. Do you believe that?
So I think we need to break this down into two pieces. First is that this market had needed to just rebound from concerns surrounding the election and how the election would play out after the actual election, whether we'd actually know on the day after or a week later or months later. There were a lot of concerns that we wouldn't know what the outcome of the election is within a month. So half of that rebound that we've seen since election day, we think is attributable to relief from uncertainty. Now set that aside and let's look at policies. The policies are probably going to be pro-cutting taxes, maybe a little bit of dose of tariffs, which we're going to have to figure out, but nobody really knows or has figured out exactly how that shakes out. We have some theories, but I don't think the market's fully figured that out. And then lower regulation. The first and last of those two things are stimulative to the broad economy and corporations, and probably more helpful to companies down the stack, smaller capitalization companies than big companies.
Well, that's what I'm curious about, too, because there's a lot of talk about policies, potential policies, we should say. This is all still hypothetical.
Yes.
But a lot of that seems like it is going to benefit investors more than sort of the real economy. I can't think of a better phrasing for it. And I am curious that when you look at economic conditions, consumer spending, obviously the big driver of that, do you see that as being healthy, irrespective of whatever changes come in January?
But to some degree, everything is kind of interrelated. But the first order impact of majority of the policies that are being put forth are actually targeting the corporations rather than targeting the individuals. So it probably helps the corporations and the marketplace first. And then there's a theory that trickles into the rest of the economy, which is probably not inaccurate. We know that one portion of the economy tends to help the other portion of the economy because you get pass-through effects. But the first order impact is probably on corporations.
Yet you also have policies like tariffs up to 60% on Chinese imports, for instance. The idea is to bring manufacturing back home, but we've already heard from Stanley Black & Decker that they will probably raise prices on consumers and that they're not going to be moving parts of their supply chain from China back to the U.S. In fact, they're going to probably do so to other parts of Asia and even Mexico. The CEO is saying there's questions about whether we even have the labor to actually do that in the U.S. Do you think that we're going to get more companies, following in the footsteps of what Stanley Black & Decker are doing?
This is probably going to be a situation where we're going to be feeling out along the way, right? So the first things that are probably going to come through are going to be the Chinese tariffs. Those are things that can actually be implemented by the administration almost on day one because it's something that can be primarily done through executive orders. Then there's the other tariffs people have talked about, or there have been talks about a 10 to 20% tariff across the board. That's actually a lot harder to accomplish from executive orders. Probably takes either legislation or some sort of more complicated approach on executive orders. And then you get this question, well, how do companies play in that environment? One of the obvious options to that is going to be sourcing more of your manufacturing domestically than internationally. Of course, that takes a long time. We're probably not going to see immediate impacts of that on day one. That's probably something that you see. They go into place now and you see impacts 3 and 4 years out.
But the price increases that they do push through if there are tariffs are going to be much more immediate.
You can see the price increases immediately. I mean, it's either one or the other. Either the corporations take it on their bottom line, which is a possibility, or there's a pass-through of pricing to the end clients, the customers. It's probably going to be a mix in between. It's probably not going to be 100% all the way one direction, but we're probably going to have a mix in between.
Jason, I do want to get your thoughts here on what we've been seeing in the bond market. Obviously, we have a pretty significant sell-off tied to a lot of the things that we've been talking about here, of course. Also, of course, tied to the Fed and what the Fed may or may not do. Is there a case to be made at all, when you look at where yields have gone, to actually buy in to the Treasury market right now, particularly at the longer end of the curve?
We actually think there is a reasonable case to have a pretty full exposure to fixed income and portfolios remain. Bond yields have gone up into the 4% plus territory for just 10-year treasuries. You look at corporate bonds or items beyond that, and it actually gets considerably higher. Majority of these yields are at or above fair valuation according to our models, even assuming a little bit more conservative Federal Reserve in its rate cut patterns. So we think investors should have generally a full exposure to bonds in their portfolios, not necessarily dramatically overweight bonds, but a generally full exposure and a reasonably full duration exposure within their portfolios at this point in time.
All right, Jason, got to leave it there. Always a great conversation. Jason Pride, Chief of Investment Strategy and Research over at Glenmede, counting us down to the closing bell. Scarlett, just about 2.5 minutes to go here, right across the screen in equity markets today.
Yeah, and also, Red, when you look at treasuries and that yields are moving higher, I'm glad you asked that question about treasuries because we definitely get the sense that the bond vigilantes, there's a lot of talk about how they're going to push this idea that fiscal irresponsibility is going to weigh on the bond market. Yeah. Has anyone ever come out and said that they're bond vigilante?
No, I mean, we talk about them, but I've never actually met one. But I'm sure they must exist somewhere in the world. Meanwhile, I do just want to point out here, as we get closer to the closing bells, a lot of interesting trades really starting to unfold as we get closer to those numbers. Stick with us. Coverage starts now.
The closing bell. Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romain Bostic here, taking you through the closing bell alongside Scarlett Fu, a global simulcast. It starts right now. Tim Stenovic in the radio booth, Katie Greifeld by his side in today for Carol Masser as we welcome our audiences across all of our Bloomberg platforms, including our partnership with YouTube. Tim Stenovic, how are you?
I'm fine. Stocks don't go up every day, though.
They don't.
I thought they went up every day.
They don't. Bitcoin doesn't go up every day either.
Well, it does. You got to prove that.
Okay.
Yeah, I don't know about that.
Yeah.
Still, though, yeah, like we've been saying throughout the day, the rally that we've seen post-Trump's win is taking a bit of a pause, but we're still up 3.5% just in the last 5 days on the S&P 500.
Yeah, for context, we're close to all-time highs, and you have to think there's some profit-taking going on right now. A lot of enthusiasm appeared in the market over the past week, and you're seeing it drain out of some of the places that really had been inflated. Do you think about small caps really taking it on the chin today?
Yeah, but some parts of the Trump trade are still intact, right? The dollar continues to move higher. That has not really slowed down. And yields after a 3-day weekend, the bond market is selling off once again.
I just want to tell you, we keep talking about how kind of the Trump trade, at least for today, is on pause. Two of the biggest stocks on a percentage basis moving today, which I didn't even know still existed, Fannie Mae and Freddie Mac.
I did not know those were stocks necessarily.
Freddie Mac up 26% here on the day. Fannie Mae up about 20%. In fact, both are up more than 70% since the election. I'm not exactly sure what people are speculating on. I guess, I don't know. Something? Can you help me out, Katie Greifeld?
No, I can't.
I know you're a big Fannie Freddie person.
I was prepping to talk about Machine Gun Kelly, so you caught me in the cold.
Yeah, I did a lot of research. The first thing Katie Greifeld, who apparently is a big fan of the program, when I mentioned that Meghan was pregnant, was she didn't know they were still together. So I went down a rabbit hole last night, so I have a lot of stuff to talk about with you later, Katie.
Who knew that you were such a font of information on Machine Gun Kelly?
Absolutely.
Talk offline.
I'm an expert. All right, let's talk about what's going on in the markets today here. Right across the screen, a bit of a pullback from what we saw over the last 5 days. The Dow Jones Industrial Average down 0.9%. The S&P 500 down 0.3%. We're going to call the NASDAQ down about 0.1% here on the day. But the big decliner, believe it or not, some of those domestic-oriented stocks that have really been a big beneficiary of the Trump trade, the Russell 2000, down 1.8%.
All right, taking a deeper look in the S&P 500, we did see more stocks move lower today than higher. 359 to the downside, while 143 stocks advanced today, Scarlett.
All right, let's take a look at the IMAP, which really maps out the sector performances, and a lot of red there, with 5 groups down more than 1%, led by materials, healthcare, and REITs. Those groups down anywhere from 1.3 to 1.6%. Your better performers here are communication services, infotech, and consumer staples, but none of them gaining more than half of 1%.
All right, let's do some gainers as we continue to await for earnings to come in.
Can I interrupt you again,
please?
Tim Stenovic? Just because I just know, not Skyworks, my producer, Stuart Paul over at Bloomberg Economics, he actually just IB'd in and says that the reason why Fannie and Freddie are rallying is because they've recapitalized and released on Fannie Mae a pet project, Katie Greifeld, of your friend, your homie, Bill Ackman.
I don't know if we're homies, but that is something that Ackman has talked about in the past. Unclear, as Stuart Paul points out, whether he's still in the preferred shares necessarily, but you were talking about speculation. What are people speculating on when it comes to these two names? It could be that, Romain.
Yeah. We have earnings, I'm told.
Yeah. I want to
Skyworks.
get over to Skyworks because we're seeing shares move higher in the after hours, up by 3.5%. Fourth quarter adjusted earnings per share did beat estimates. The company sees first quarter adjusted earnings per share coming in below estimates at $1.57. Estimates were for $1.69. The company sees first quarter revenue coming in about $1.05 billion to $1.08 billion. That's shy of estimates of $1.09 billion. But for the previous quarter, fourth quarter revenue coming in above estimates or within line with estimates, and then adjusted operating income coming in just shy of estimates. Shares in the after hours right now higher by 5.7%. Okay, as we do await other earnings, I do want to get to some of the stocks that did move higher in today's session, starting with Tyson Foods. Intraday, the company surged the most in more than 2 years. It did rise by 6.6%. It beat fiscal fourth quarter earnings estimates. It projected stronger results next year. Chicken, it's so hot right now.
Yes.
A turnaround in its chicken business, offsetting losses in beef.
Feeling bullish on chicken.
It's Tyson's second largest source of revenue.
How long did it take you to come up with that, Katie?
I actually made that joke earlier this morning. So.
Okay, so
wait, you're recycling jokes on the clothes?
Big time.
Different audiences. It's okay.
The demand for chicken has improved as consumers are looking for cheaper alternatives to beef. Plunging prices for corn and soybeans also made it cheaper to feed those animals. Also, shares of Honeywell International surging today. This after Bloomberg reported that Elliott Investment Management has built a $5 billion plus position in the company, and it's pushing the company to pursue a breakup. Shares ended up finishing the day higher by about 3.9%. And finally, Shopify shares surged after the company reported third quarter results that beat analyst expectations. The company also gave a strong outlook.
All right, let me just jump in here because Spotify did come out with some numbers here. And Spotify's third quarter revenue was just under 4 billion euros when analysts were looking for 4.03 billion. Gross margin for the period was 31.1%. That is higher than what was anticipated. And the total premium subscribers, 252 million, also slightly higher than what was anticipated, 250.06 million. And monthly active users, 640 million, compared with the consensus estimate of 639.
Yeah, it's really interesting to see this big reaction in Spotify, given that the shares were already higher by about 123% year to date. So it was a high bar, and it takes a look. It looks like that Spotify has surpassed it, at least for right now. You take a look at that stock reaction.
And it's a big deal also because this was the quarter in which they raised prices. So clearly investors are swallowing that and continuing to pay up.
Spotify shares up about 8% here in the after hours trade to the downside. Instacart, Maple Bear, the formal name, those results out. Revenue in the most recent quarter coming in at about $852 million. That is a beat. The bottom line number, $227 million on an adjusted EBITDA basis. That is also a beat. The outlook for the fourth quarter, though, this might be why you're seeing weakness in the shares. Adjusted EBITDA of $230 to $240 million. The top end of that range is below the average of street estimates. Instacart also saying that fourth quarter gross transaction value will come in the range of $8.5 to $8.65 billion, and that outlook includes the Ahold outage impact as well. Shares now moving even lower, down about 8%, Katie.
All right, very much in earnings season. Let's talk about Flutter as well, coming out with numbers, narrowing its full year U.S. revenue forecast. Taking a look at some of the numbers over the third quarter, though, the adjusted EPS coming in at 43 cents. The estimate had been for 68 cents. Revenue, though, coming in heavier than expected. Third quarter revenue in at $3.25 billion, above estimates of about $3 billion. And you take a look at full year adjusted EBITDA, it's seen between 670 million to 750 million. That is above, or interesting, you take a look at the past range, that was between $680 million to $800 million. So a narrowing there. You can see shares moving up a little bit right now, currently higher by about 2.4%.
I'm going back to Maple Bear, also known as Instacart. I'm picking through the investor letter. The font is small, the pages are many. 20 pages. But one thing that the company talks about, which I find really interesting, is integration with different companies. So, for example, if you want to order Costco to be delivered, you got to use Instacart there. So you might not necessarily be an Instacart member or use Instacart in any other part of your life. But if you want Costco groceries delivered to your home, or they say Sprouts groceries delivered to your home, you got to use a platform like Instacart. The company is continuing to push more of those partnerships as we speak.
Yeah, the exclusive partnerships is what makes the difference, right? And sometimes people, if you don't have those other options, you just have to pay up for it. Really interesting that Instacart is the read that Instacart gives us on consumers' willingness to spend on, sometimes you would think it's discretionary purchases, but in the case of groceries, a key staple purchase.
Yeah, I mean, I am curious, though, too. I mean, I wonder if they can articulate on the conference call as to how they kind of keep the growth going. I mean, the partnerships certainly help here, but I know there was a lot of talk in the past two earnings cycles that we had with them that the uptake, meaning the number of people who were using home delivery, and this is primarily here in the U.S., that had not only tapered off, but in certain markets was actually falling.
It's really interesting to think about the human psychology piece as well. When you think about Instacart, so many people were ordering online their groceries during the pandemic. Yeah. And that's one of those behaviors that really stuck. I mean, I know a lot of people who, even though they live in the suburbs, they have a car, they can go to the grocery store. It's just easier to order.
Yeah, absolutely here. So we're keeping an eye on that. One of the big movers in after hours trades, Flutter as well, Spotify, your big gainer here in the after hours trade as we wrap up our global simulcast here of a breakdown here of what happened in the market today, our cross-platform coverage of the close right here on Bloomberg Television, radio, and YouTube. But we are going to stick with our radio colleagues for just a bit longer here. They have a sit-down interview coming up right now with the CEO of Delta, Ed Bastian, and the CEO of Wheels Up, George Mattson.
For that, Romaine. Well, last month, Delta Airlines forecast profit and sales that fell short of Wall Street's estimates for the final months of the year, suggesting a slow recovery from a challenging summer travel season. For an update on the business and the latest on Delta's partnership with the private on-demand aviation provider Wheels Up, we bring in Ed Bastian, CEO of Delta Airlines, and George Mattson, CEO of Wheels Up, both joining us from Atlanta. We should note that Delta does own close to 40% of Wheels Up. That's according to Bloomberg data. Guys, thanks so much for joining us. We're going to get to the Wheels Up partnership and the exciting news that you guys have when it comes to new aircraft. But I wanted to ask each of you the same question that I've asked every CEO that I've spoken to over the last week. Ed, I want to start with you. What does a second Trump administration mean for Delta Airlines?
Well, I think you've seen from the market's reaction, there's a lot of optimism in the corporate community. I know for Delta specifically in the aviation industry, the former president, now the current president-elect, knows our industry quite well, was very supportive as we worked with him in his previous administration, particularly as we went through COVID, got the support. We were the original industry that got the CARES Act started and the support to keep our employees employed. And we look forward to continuing to work with him in a second administration.
What about, Ed, when it comes to regulation during the next administration? Because I think many people would say the Biden administration took what some would call a hostile stance on airline M&A. Do you expect that to change under Trump? Will it lead to a new round of airline consolidation?
I don't know about consolidation. I guess that's possible, but I can tell you that the Biden administration, particularly the Department of Transportation, who we work most closely with, we were quite frustrated with the amount of regulatory overreach that we saw continuously through the last 4 years. And we hope there's a new sentiment that's pro-employee, pro-consumer, pro-business, and a good balance between the three.
And George, let's ask that same question to you. You think about a second Trump administration. What would that mean for Wheels Up?
Yeah, thanks, Kate. I think, as Ed said, the prior administration, obviously there was a strong support for aviation in general, U.S. aviation in particular. What really drives our business as much as anything else is a good, solid, strong economy. Obviously, the markets have reacted very positively to the results of the election, and the economy appears to be quite strong and resilient. And I think ultimately that's going to support our business plan going forward.
And let's also talk, of course, about the relationship between your two companies, Delta and Wheels Up. And Ed, I'll ask you this question. Delta, according to our data, owns more than a third of Wheels Up. You've also supported Wheels Up with credit and access to capital. Why own so much of Wheels Up? What is in it for Delta?
Well, what's in it for Delta is the opportunity to create a new level of premium in commercial aviation that hasn't previously existed in terms of a partnership, and more than just a partnership, it's an ecosystem that's linked between private and commercial. We know many of our private aviation consumers also fly commercial, fly in Delta, and we want to make it easier for them to make those choices when they have the opportunity to fly private, and vice versa. When there's private aviation consumers that may occasionally need a commercial flight, whether it's going to Europe or some other place, we want Delta to be their airline of choice.
Ed, would you consider buying the company completely?
No, that's not in the cards. We deliberately wanted to make certain we had investors with us when we made this decision. And I think having the external validation of investors beyond just Delta was helpful.
Hey, George, I want to talk about the fleet because there was big news last month when Wheels Up said it would buy the Embraer Phenom fleet from Grandview Aviation. It's a $105 million deal. It's part of this 3-year plan to transition to Embraer and Bombardier Challenger aircraft. You're also, though, moving away from Cessna Citations. What's the thinking behind this, apart from just a newer fleet?
Yeah, thanks, Tim. When I arrived here just over a year ago, having spent 11 years on the Delta board, we obviously had a number of first-day priorities, but one of the priorities over this first year was building a long-term strategic plan and a fleet plan that supports that plan. We have a significant, loyal, strong member base, a really strong brand. Most of our members have been individual leisure customers. We are increasingly becoming a provider of choice to corporate customers. I think through our Delta partnership, that's only going to become more important going forward. As we looked at our fleet, it was a little older than we wanted it to be. And it was a little bit more complex than we wanted it to be, with 4 fleet types operating, which we've now distilled down to 2 fleet types. And in deciding to modernize the fleet, what we did is we basically selected the 2 most popular aircraft types in their respective categories with the deepest install bases, the largest secondary markets, in order to be able to buy those aircraft at fleet scale over a period of time. This is going to really significantly transform the product offering we're able to deliver to customers, the experience, the reliability, the efficiency that comes both with the aircraft themselves and also the simplification of the fleet. We're going to enhance that fleet with best-in-class connectivity. I think Delta was a real leader in providing free, high-speed satellite Wi-Fi on their aircraft. We've announced a commercial partnership with GoGo to provide a similar low Earth orbit satellite Wi-Fi capability on all of our aircraft. We're very excited to have been able to jumpstart this fleet transition by acquiring Grandview, which has the largest fleet of on-demand Phenom 300 and 300Es in the market. And that transaction is going to close very, very soon. And we're going to immediately be able to offer that at fleet scale to both our charter customers, but also our programmatic member customers. And I think when you look forward at the progress we're making financially in the first year, this fleet modernization is an important unlock for the next phase of that profitability journey as well.
And I also want to talk, of course, about Delta's fleet. And Ed, we have to talk about Boeing. You're a major Boeing customer. And to put it mildly, the company has had a lot of problems. They've recently raised new capital, though. They've gotten past the worker strike. But that being said, how quickly do you expect Boeing to actually get back on a normal production schedule here? And are you anticipating further delays when it comes to deliveries and certifications?
Well, we're, as you may know, not anticipating any Boeing deliveries because we have none outstanding in the next couple of years. So in the immediate term, we're not impacted at all. But I do believe that they have made the right decisions around raising capital to invest in their business, around making certain their employees are properly taken care of and compensated. And so they can get back, focus on delivering high quality airplanes to our industry. I think it's going to be a number of years before you see a steady stream of airplanes starting to return, and we'll hopefully sooner. But I think we are all realistic that this is going to be a very challenging turnaround still to come.
When you say a number of years, would you count that number on one hand or two hands?
A couple fingers, how's that?
Okay, so a couple. I like that. Hey, we're speaking with Ed Bastian, CEO of Delta Airlines, and George Mattson, CEO of Wheels Up, both joining us from Atlanta. Ed, while we have you, give us an update on capacity in the market here. We hear it's improving, but is it improving for both premium and economy seats right now?
The market has rationalized. I think this past summer we saw in the U.S. marketplace there were a lot of seats for sale, had a pretty big impact on pricing. A number of the airlines, particularly those on the lower end of the price scale, have been struggling. Most of them have lost money this year, lost money in the peak summer even, and have had to implement a number of self-help measures to ensure that they can find better balance between supply and demand. On the premium side, that's where the growth has been in the industry, and Delta has led the way. And any of the airlines, there's a couple of us out there that are more focused on premium, have done quite well over the past couple of years. However, those that are more in the commodity sense, where price is the principal determinant of the consumer purchase, they've struggled, and they continue to struggle, and that's why you see the supply being rationalized.
So that's the view on the commercial airline demand. George, give us a peek inside what demand for private airspace looks like, because you think about coming out of the pandemic, we know that there was a big uptick when it comes to private jet travel. What are you seeing right now, especially as we head into some of these peak travel demand periods?
Yeah, I think in general, I would just say that the industry remains quite healthy. We certainly saw a very big sort of demand bubble from COVID, and when people did start returning to flying, a lot of folks who hadn't flown private started to fly private, and so we've seen that, I would say, normalize. The industry feels relatively stable here, but I think when you look kind of medium and longer term, has really strong macro headwinds, right? I think the vast majority of aircraft, private jet aircraft, are still wholly owned by individuals or corporations. And so the opportunity for on-demand and fractional providers to continue to grow, I think, remains very strong. As commercial aviation becomes in some ways more challenging with congestion and other challenges, I think it becomes a more interesting alternative. And I think one of the really interesting things about what we're doing with Delta is really trying to break down the barrier that has always historically existed between commercial and private aviation into one, seamless aviation solution. And so I think as we are successful in doing that, we're going to draw more participants into the industry, hopefully through our offering, and expand the market in the process. But to answer your specific question, I think generally things feel quite healthy right now.
Yeah. So George, help us understand the profile for somebody who would, maybe they're a Delta One customer.
And you're listening to a conversation with Delta CEO Bastian and Wheels Up CEO George Mattson, alongside Bloomberg's Tim Stenovic and Katie Greifeld in our radio studios. In the meantime, a lot of earnings have come through. We want to just take you to what they're doing right now in after-hours trading. You could see Kava higher by 13%, Instacart lower by 4%. What do you have for Kava?
All right, let's go look at Kava here. Third quarter results, a big beat there. EPS coming in at 15 cents a share. That's double what they posted about a year ago and above street estimates. Revenue also growing about 39% in the most recent quarter, also coming in above estimates. And the guidance that they're giving going forward, well above estimates. 12 to 13% comp sales growth for the full year. Its previous forecast, Scarlett, was for 8.5 to 9.5%.
And we're looking at Spotify rising about 9% after hours trading after fourth quarter. Monthly active users topped analyst estimates. There was a tough climate for advertising, but cost cuts helping the gross margin also surpass what analysts were anticipating.
Another big mover is Flutter. Those shares up about 5% in the after hours trade. Those earnings just crossing the wire here. Adjusted EPS coming in at about 43 cents a share. That compares to a loss in the year-ago quarter, though it is a little bit below what the street was looking for. Revenue did increase by about 27% to about $3.25 billion. That is a beat on what the street was looking for, and some tweaks here to its revenue and adjusted EBITDA guidance going forward for the full year. Let's get a little bit more context. Well, from the man who knows more about it than anyone else, the CEO of Flutter, Peter Jackson, joining us first here on Bloomberg on the heels of that report. And Peter, let's talk about first the revenue growth in the most recent quarter and your revenue guidance for the full year. What's the complexion of that?
Hey, Romain, great to see you. We've been really pleased with a very strong Q3 performance where we beat market expectations. As you say, revenues were up 27% year over year, EBITDA up 74% year over year. If we take FanDuel, which is our biggest business, revenue in the quarter up 51% year over year. We made a profit in Q3, which beat expectations in the street, and we maintained our leadership position in the US. We've increased our EBITDA and revenue guide for 2024, and that's off the back of the strong momentum we're seeing in the business.
There has been some concern here about some of the losses that Flutter saw, and specifically FanDuel here in the U.S., I should say, saw when it came to some of those bets on NFL games. And I know that you can't always sort of control how things are going to swing, but should investors expect a repeat of that in the quarters going forward, or was that just a one-off?
Look, we are very pleased with the momentum that we saw in Q3. FanDuel's doing very, very well. Beginning of the fourth quarter, look, I was at the New York Jets game when the Bills came, and
My
they more than
condolences,
covered the spread, and that was a fantastic evening for customers. That happens, but we've got fantastic product in the market. Parlay penetration up 700 basis points year on year. We've got the best product for customers in the market. There are days they do really well, but our pricing accuracy means that we have the best margins in the market. And that's why you've seen revenues up 51%. It's why we're number one in America.
Yeah, I'm looking, and we're talking, of course, about week 6 of the NFL season, which created what a lot of analysts are calling adverse effects. As you look at what happened, Peter, what are the learnings from that? Or is the learnings just sometimes the ball doesn't bounce your way?
No, there's gives and takes, right? We get the benefits of our global diversification. So, we can be losing to customers on football in FanDuel, but we can be winning off them in soccer in the UK and Italy. The global diversification helps our business. And look, from a US perspective within FanDuel, we'll have some good days, we'll have some bad days. The 13th, 14th of October wasn't great. 27th of October, tight end day. You can't make it up. The number of prop bets we had on tight ends and hit record numbers that day. So, that was a fantastic day for customers. We're delighted for them. We're delighted they're winning with our parlay products. We've got the best product in the market. And, it happens sometimes, and, we're pleased for them.
So give us a sense of what the change in government also means for your business. This is something that we've been asking a lot of CEOs because it clearly changes the regulatory environment. It clearly changes animal spirits overall. From where you sit, what can you do differently now that there's going to be a new administration?
Well, I was very focused on the U.S. election, particularly Amendment 2 in Missouri, which was a ballot referendum to see whether sports betting would be legalized. We were delighted it passed, I think, by 7,000 votes. So in Q4 next year, we'll be live in Missouri, offering our customers there the best product in America and giving them access to FanDuel. And we expect to see continued momentum in opening up new states, and that's what's going to set us up on the trajectory to deliver the strong growth in the years ahead for the business.
I am curious, though, if we do start to see an opening, Peter, of more states relaxing rules on gaming, allowing basically forward entry of a Flutter, of a FanDuel, or your competitors here, does that not cannibalize what you're getting in the states that already allows it, or is that not a concern?
No, we've seen very strong growth in the business. We've had a 10% growth in new customer acquisition in the third quarter in FanDuel year over year. We're up 6%, in existing states. So, there's very strong momentum in the business. When we see a state open up adjacent to an existing state, our customers, take advantage of it. Our refer a friend program is very powerful. We're the number one player in the market, and we take, advantage of these new states opening up, and it's really helping drive the growth of the business.
You mentioned parlay a couple of times. I'm curious as to what specific products you see driving growth next year.
The parlay product has been, really important for us. Player props, fandom, we know what it's like. I talked about tight end day. The amount of prop bets on Travis Kelce, is huge, right? So, fandom is really important. We're getting behind that. There's lots of incremental improvements we're making to the product. But we're also, we're driving improvements in our iGaming proposition as well, whether it's the unique content we have on the platform, some of the jackpot promotions that we're making. Across the board, there's fantastic product for customers.
I have to ask you, Peter, here about the so-called prediction markets when it comes to elections. This was, at least here in the U.S., probably the first time where we saw, I guess, any sort of illegal use of some of those platforms. And I am curious as to what sort of presence Flutter had and what type of presence you expect to have in the future.
In the markets where we're allowed to take, betting on politics, we do. So our Betfair exchange, which is a peer-to-peer platform, had around 250 million sterling bet on it, on the US election. So we have the technology and the capability to do this. And the extent to which we're allowed to, with the FanDuel brand, we'll be delighted to make it available for customers.
Going forward, Peter, any plans for expansion? I know that you recently agreed to buy Playtech's Italian gambling business for about $2.6 billion in cash. What are you looking at in other parts of Europe, in the US?
We're very excited about our Italian business. If you look at our online business we already have in Italy, we're up 40% year over year in the third quarter. So we'll be excited to add to the position we have there in Italy. There's lots of opportunities for us to expand our business internationally. There's many markets where we're not the number one player. And the ability to take our product, our expertise, our technology, and our scale into those markets is something which will really add value to our shareholders in the future. There's a $300 billion TAM outside of America, and we intend to be number one in many of those markets.
All right, Peter, really appreciate your joining us. Peter Jackson is CEO of Flutter, which of course is the parent company of FanDuel. Now coming up, we're going to stick with earnings because we've got results out from SoundHound AI as well. The CEO, Keyvan Mohajer, will be joining us next. And remain AI, of course, certainly a big theme, but just as important is the return on that investment.
Well, that's the thing, and we've seen that, of course, from the bigger companies involved in this, whether it's a Microsoft, Alphabet. I'm starting to see companies like this that are much more pure plays, what they have to say here about that going forward. Stick with us. A lot more coming up here on The Close on Bloomberg.
One stock that we're watching is SoundHound AI, ticker SOUN. Shares of the voice recognition company plunging, or is now down in after-hours trading following its latest results. Joining us now is the company's co-founder and CEO, Keyvan Mohajer. And Keyvan, I look at the results, and your third quarter revenue and bottom line came in better than expected. Revenue of $25.1 million, higher than the expected $23 million. And the bottom line was a loss, but it was narrower than what was anticipated. However, gross margin did miss for the quarter. What does that say about the cost side of your business, especially CapEx?
Oh, thanks for having me. We had a great quarter. It was a comfortable beat and raise quarter. We broke a lot of records. As you said, revenue was over $25 million for the first time. That's up 89% year over year. We also beat on the EPS. We had some one-time acquisition costs that impacted the gross margin, but those historically have improved over time after we've done our acquisitions. We also raised guidance. Now we expect this year's revenue to be between $82 and $85 million, and it will grow even further to $155 million to $175 million next year.
So in terms of what happened over the quarter, you say that you've taken your first steps into important new verticals. Can you talk a little bit about what that is, especially as it relates to the different pillars of your business, whether it's devices or whether it's customer service?
We are already in millions of cars and TVs, and we are the leader in AI for restaurants. Now we've entered some really exciting new verticals, like we are in healthcare, financial services, insurance, retail. And if you think about it, we believe the AI agents for customer service is really the biggest opportunity in the near term that generative AI brings. So generative AI is going to impact a lot of things, but it's really the AI agent for customer service that's really going to be everywhere.
Talk to me about a little bit more about your clients, Keyvan. I mean, I'm not sure what you can tell us, but when you talk about increasing the business and getting more companies and more users on board here, how much progress did you see in the most recent quarter? And can you share any of the names that you might have picked up?
We are growing with the existing customers and signing new ones. For example, in automotive, we saw growth in unit production from our existing customers. We also were able to increase the royalty per unit because of our generative AI enhancements. And this is like something for the first time we see. In the past, we've been in this business for many years, but we innovated, but they still asked us to reduce our fees and royalties. But now that we offer them the upgrade with generative AI, we are actually seeing them, they're willing to pay more for that enhancement and upgrade. So That's great to see in automotive. We also signed new deals. We are working with 4 EV companies. 2 of them are live in production. And we are now in more than 1/3 of the top quick service restaurants.
But is there a sense, though? I mean, if you're having to offer some incentives or maybe some sort of additional carrots here with regards to some of those relationships, is the idea here that some of these companies are taking a closer look at their AI spending? Are they being more scrutinous of it?
We are actually seeing a big change in the way companies are looking at AI. We've been in this for 20 years, and we used to win innovation budgets from forward-looking companies that were trying to explore new things like AI. But now we are winning the IT budgets. So it's going from innovation exploration to a mandate. So companies are saying, we need this, go find a vendor. And SoundHound really shines as a partner of choice for their AI ambitions.
Keyvan, your loss per share in the third quarter was 6 cents, narrower than what analysts had anticipated. And I know that as a young company, you're always trying to balance growth versus profitability. And of course, growth means investing in that business. Give us a sense of what your timetable is when it comes to actually turning a profit.
We are projecting to be adjusted EBITDA positive by the end of next year. It's a big goal, but we've increased our guidance on revenue, so the 155 to 175 million. If you look at the midpoint, it's more than 100% growth from this year. And we see a lot of cost synergies with some of the acquisitions we've done. We also see a lot of cross-selling opportunities with their customers versus ours. So we are very confident in that goal.
Obviously, you've had a great deal of growth, Keyvan, but I'm sure, as you know, there has been at least the whiff of consolidation going on in the AI space. And I'm wondering if you've had any conversations with any other companies about either partnerships or, more importantly, M&A.
We have bought 3 companies, and we are getting really good at it. Our acquisitions we think they're really smart acquisitions, and they've accelerated our growth. I also think, I hear about, are we in a bubble? But actually think we are not in a bubble. We are just starting this inflection point. If you look at what happened in the last 10, 20 years, there was a time that every business needed a website. And then in the mobile era, every company needed a mobile app. But now we are entering a new era where every company and every service will need its own AI agents. So we are starting the agent era, and that is just the beginning, which is super exciting. And we are really one of the pioneers in that era.
All right, Keyvan, got to leave it there. Appreciate you taking time for us on what I'm sure is a very busy day for you. Keyvan Mohajer, co-founder and CEO over at SoundHound AI.
All right, let's take a look at some other companies that are moving in the after-hours trade. We're going to start with Mara Holdings, moving down about 3.5%. Total revenue in the quarter, missing analyst estimates. Topgolf not moving at the moment, Romain.
Yeah, Topgolf earnings are out. Adjusted EPS coming in at about 2 cents a share. That's actually better than expected. The street was looking for a loss. Net revenue also coming in above estimates, and their guidance for the full year, adjusted EPS of 8 to 13 cents, a bit of a narrowing of that forecast that they gave last quarter. Street looking for 16 cents a share, so basically coming in below that here, unchanged on the day.
All right, and Occidental Petroleum, the exploration production company, also coming out with results. A beat here on the bottom line, adjusted EPS of $1 versus a consensus estimate of 76 cents a share. And you are looking at the stock moving higher in after-hours trade by 1.8%. This is the close on Bloomberg.
Welcome back to the close. A lot of earnings still crossing the wire. A lot of big movers in the after-hour trade, and that includes the mortgage company Rocket. Those shares down about 10%. This after the company provided a forecast that came in a little bit light. Fourth quarter revenue, they're seeing $1.05 billion to $1.2 billion. Street was looking for $1.3 billion. That's for the fourth quarter, and that kind of belies the strength that we saw in the third quarter, a 32% jump in revenue that beat expectations. Nevertheless, this is a forward-looking market here, and forward-looking, not looking so good.
Yeah. We're also looking at Kava Group moving in after-hours trading, and I'm mesmerized by the jump in Spotify from being up to now being unchanged. I'm wondering if that has to do with the earnings call that's taking place right now. But Kava boosting its outlook. Certainly, this has been a very successful story when it comes to fast casual and how it's really stealing a lot of customers from the fast food industry and the sit down with cloth dining. I'm
going to brag and just say that I knew this was coming because my brother-in-law, he only eats at this place. He's been doing this for a couple years. And he's
like, the litmus test.
Yeah, and I was like, and this was like before it went public. I was like, what are you doing, dude? He loves this place. There are like some rabid, like loyal fans at this place. And the geography of it too. I mean, he lives in a very rural area and he doesn't have a lot of options. And Kava, that was a big strategy there.
Well, and look at the suburbs. They've got a small presence, so they're growing
rural
too.
areas, yeah. So anyway, big part of the reason why you're seeing the moves there. Let's keep the conversation going here, a broader discussion about what we've been seeing in the market and who better to do that with than Mark Lehmann. He's the CEO and president of Citizens JMP Securities, and for some reason he's joining us here in New York. Great to see you, man.
Great to see you too. Thank you.
Let's. I mean, before we get into the nitty-gritty, I do have to ask you about the election, and more importantly, some of the market euphoria that we've seen since then. I guess, did you expect to see this type of market reaction?
I thought we would see a relief rally irrespective of the outcome. This one felt like there was so much tension going into the election, more so than I've seen, frankly, in my election ecosystem that I've been a part of for over 40 years. So I expected a relief rally for sure. The depth of the rally, though, has surprised me. And I think the kind of trade that we're seeing is unsurprising in terms of the sectors that are winning and the fear for some that are not.
Well, let's talk about some of those sectors because, I mean, yeah, sure, some of this is certainly a relief rally. Some of this, though, is also people trying to make a bet on policy positions that might come to fruition in January and beyond. Tech, that's basically been the star of the show for this market for the last few years here. There is concern here that a lot of those big tech names aren't necessarily going to be the beneficiaries in this new administration.
Yeah, I think there's a fear about what it means. A lot of the big tech benefits internationally, and I think some of the international fears are definitely haunting some of the market darlings of the last few years. I think there's also a rotation that was naturally going to happen anyway, and I think we're seeing a little bit of that. But there's a little bit of a tech rally in some of the other stocks that we cover. Some of the Israeli tech stocks have done a lot better. That's been kind of hiding underneath this sideways market for at least tech the last week. So I'm not saying tech is dead by any stretch, but they had a lot of fun the last 4 years, and I think they're going to have a lot less fun, at least in the near term.
So all the Mag 7 has reported except for NVIDIA. And when you look at the responses after those results, Alphabet and Meta were kind of the only outliers in which investors weren't disappointed. How does this set us up for where investors' heads are when it comes to NVIDIA's results?
Yeah, I mean, there's so much optimism there. At Citizens, we have a big data centers presence, so we understand a little bit what's underneath in the NVIDIA earnings. I think the demand for data center investments and the demand for data centers has just not slowed down whatsoever. In fact, it continues to accelerate, so I think that's a good backdrop for NVIDIA. Obviously, they have some big tech fears. I think that just envelops this market a little bit, but the fundamentals are only accelerating, and I think you're going to see that when they report.
But is the bar lower or higher now?
I think for all these stocks, the bar is higher. Like you said, only a few of the Magnificent Seven took off here. I would expect them to have high expectation and exceed those mightily.
I do want to talk about deal making and the idea that this market has been relatively closed. We haven't seen a whole lot of M&A activity, certainly haven't seen a lot of new IPOs. I am curious as to whether the regulatory environment, and more importantly, just the risk appetite out there, is going to shift enough where we're going to see a meaningful return of activity in that space.
I would expect there to be a big first quarter relative to what we've seen, obviously, the last 3 years. Just this weekend and going into this week, I've been on several phone calls with people who are ready to tap the markets. So I would be surprised, frankly, if that did not happen. I think the regulatory backdrop, it'll be quiet through the end of the year until the new administration takes over. But I think some of that fear that people have that things will not get through the administration is going to be behind them. So I would expect that to open up mightily going into 2025. And I think the IPO window will open. People have been waiting for this. We're not going back to the 2021 year, which was so buoyant. But I think there's plenty of companies who are ready now and big enough.
Yeah, how many unicorns are out there right now in the private space?
More than there were a few years ago. Remember, the trough valuations that we saw post-COVID are starting to get realized. So we're starting to anniversary those. And I think there's so much money on the sidelines, so we're expecting that.
So in terms of timeline, are companies just now starting to, get their ducks in a row when it comes to either going public or transacting with M&A, or is it something where they're going to have to wait until there's an actual change in government or people are announced?
I think it's a combination. As I like to say, unfortunately, I'm not in the immediate gratification business, so these things don't happen overnight. Getting your on file and getting the analyst day together and getting your roadshow together takes time. And obviously the M&A backdrop also takes time. So we have a lot of people who are getting prepared for 2025. That is going on for the next 7-8 weeks going into the end of the year. Yeah. But it's palpable what's going on. You're going to see some financings before Thanksgiving. I think you'll see a flood. It's a shorter week, right? Thanksgiving is as late as it can be, so it's a very truncated time between then and Christmas. Yeah. But I think you'll see a very busy early December.
Yeah, it's really throwing off my holiday plans here. I am curious though on the IPO front, and whether like AI is just going to kind of suck all the air out of the room. I mean, there are some gigantic companies, of course, OpenAI being probably one of the biggest in the private markets, and most people think these are companies that are going to go test the public markets relatively soon here. Is that really going to dominate in 2025, AI?
I think it'll be a backdrop for most stocks. I mean, even the companies that reported today have AI in their name, and everybody wants that halo for sure. Yeah. I don't think 2025 will be the year of the data center IPOs. I think 2026 might be that year, so I would wait for those. But I don't think it's just AI. I think there's a whole class of people in software, in cyber, in fintech, in payments, in internet, in insurance that have been waiting to tap the public markets, and I think you're going to see a lot of that in 25. I think it'll be more broad than we've had. 2021 was a tech IPO year. I don't think you're going to see it as narrow as that for 25.
That was the peak. Okay, so you're normally based in San Francisco. Romain said you're in town today, so glad to see you here in New York. What's the number one question?
Yeah, what's the better city? That's the question.
We know the answer to that,
don't answer that.
What's the number one concern that your clients have, those that are in the Bay Area?
Yeah, listen, I think the Bay Area's gotten a bad rap, some of it self-deserved. And I think the worst is behind. We have a new mayor. We have a new city council that will change, I think, some of those perceptions and realities of what it means to live there. I think it's still the center of AI innovation and fundraising for that. I think the number one question mark for a lot of people still is, what are the ramifications of the Trump administration for interest rates? What is ramifications for taxes, et cetera, that I think is going to take some time to work out. But I think the optimism of the election being behind is real. I also think some of the policies of the Biden administration, Build Back Better, onshoring, deglobalization, the tech trade is here, okay? We are the best market in the world. We have a great lens at Citizens because we see so many companies and we finance so many companies. That trade is going to happen, and it's going to happen right now from 24 through the rest of the decade, and that's domiciled in the States.
All right, Mark, always a pleasure. Thank you for stopping by. Mark is CEO and president of Citizens JMP Securities. Mark Lehmann. All right, still ahead, we're going to set you up with what to watch tomorrow, including a big CPI print. Phoebe White of JPMorgan will be joining us next. This is The Close on Bloomberg. Another batch of consumer data due this week with CPI numbers out tomorrow morning. Headline and core CPI inflation expected to hold steady in October. And while most economists expect another quarter-point cut from the Fed in December, tomorrow's print coupled with core PCE may be able to change that. Joining us now for more on this is Phoebe White, head of U.S. inflation strategy at JPMorgan. So, Phoebe, do you think that CPI could surprise to the upside or downside in a way that could make that December rate cut in question?
Well, so first off, we are looking for an above consensus 0.4 increase in core CPI, 0.36 unrounded, so still pretty close to rounding to 0.3. We do think that the year ago rate of core CPI inflation actually ticks up from 3.3 to 3.4. But we still think actually that the Fed will continue with a cut in December. I think that is what we heard from Powell last week. I think that right now the Fed is focused on continuing this process of bringing policy rates closer to neutral.
Well, where is that? And I know that's kind of the holy grail question here, Phoebe, but it gets to this idea that everyone's talking about, I don't know, a few months ago, like the fight against inflation was won, or at least we were on our way to winning it. But we've seen the reaction in the markets now, some of this related to the election, some of this related to other issues. But this idea that maybe that disinflation trend has stalled and maybe we should be preparing ourselves for a potential uptick in inflation going forward.
right? So I think right now, as we're sort of preparing our year ahead outlooks, we're really focused on all the uncertainty around the potential policies that could be introduced under the new administration, right? So I think you add up kind of the range of outcomes that we could see in terms of sequencing, timing, and size of those policies. I'd say that there are two-sided risks to the growth outlook, but I think actually risks to inflation are pretty much skewed to the upside, and that comes from the potential for sizable tariffs, right, depending on how exactly those are implemented. But of course, if we see more widespread tariffs or, more retaliatory tariffs from other countries, certainly we can imagine a scenario where the impact to consumer prices is pretty sizable. We also think about the potential for mass deportations and what that could mean for low-end wage growth. And even the pro-growth policies in terms of deregulation and looser fiscal policies, I think, you kind of think of the range of outcomes, and we are thinking about upside risks to inflation here for 2025.
Which market indicator are you looking at in terms of inflation expectations? Is it the 10-year break even? Is it something else?
So I think what's been fascinating about this move across the yield curve recently is that really big increase in inflation expectations has been pretty concentrated at the very front end of the curve, so really only out to the 2-year point. I think that makes sense when you think about the potential impact from tariffs being more of a price level increase, not necessarily pushing the inflation process higher. But again, when you think about how much we've seen long end Treasury yields move up and actually the whole curve Treasury yields move higher, we haven't actually seen those longer run inflation expectations move up as much as we would have expected in that kind of environment.
So Phoebe, if you had the opportunity to be in that room at the next Fed meeting here, what would you argue for? Would you argue for continuing with these rate cuts or maybe sit and wait?
So I think there's still a case to make, one more quarter point adjustment lower in December. But I think by the time you get to January, if we are looking at labor markets that are still solid, inflation that's potentially proving stickier, and, very sizable policy uncertainty, I think it would make sense to start to slow the pace of cuts, right? And that is actually what we are now forecasting. So we now look for a quarterly pace of rate cuts in 2025 versus previously looking for an every meeting pace of cuts.
All right, Phoebe, got to leave it there. Phoebe White over at JPMorgan Securities, a closer look at what the Fed may do next. And of course, a big CPI report tomorrow morning. Some breaking news, actually, while she was talking. Remember Mark Lorry, of course, founded Jets.com, Diapers.com, and now he's running Wonder. Remember we had him on to talk? Well, Wonder in talks to buy Grubhub. This according to the Wall Street Journal. What do you think about that?
It's M&A. Everything's open season right now.
I just had a chance to go to one of those Wonders finally. There's one right up the block, not
they
too
haven't
far
opened
up
yet, have they?
No, yeah.
They just
I
opened?
walked past it. Was it last weekend?
Okay.
So right there on like 65th, 66th up there. So yeah, give it a try.
All right. Well, we'll see how it goes. Come back with your review.
My ringing endorsement there for my meal that I had, not the company necessarily itself. Here's what could potentially move the markets over the next 24 hours, and we're going to start with a monthly budget statement, 2 p.m. Eastern time. Who you got?
Yeah, it doesn't move the market, really. I mean, the CPI will, but not this.
Yeah, did I pick that? Did you pick that?
Well, we had to move on because we already talked about CPI.
Okay, we got earnings coming out as well, including from Cisco.
Cisco, J&J Snack Foods, Rakuten, and Tencent Holdings. Kyle Bass talking about not wanting to invest in Chinese companies. There's a Chinese tech name for you.
And you got Rakuten up there, of course, technically a Japanese company with a big presence here in the U.S. And I know you love it, Scarlett. Fed speak. Rattle them off for us.
Williams, Logan, Musalem, Schmid. I mean, what are they going to say at this point? It's all about the new administration.
And Kashkari right here on Bloomberg, Scarlett Fu, the most important one. Don't miss that.
8:30 a.m. before the market opens.
New York time. You can hear from the Minneapolis Fed president. Tomorrow also we're keeping an eye on Washington, where the Republican Party is expected to vote on leadership for the U.S. Senate.
What do you have on your bingo card?
I don't know. I mean, if you had asked me a couple weeks ago, I would have said definitely Cornyn, but it looks like Trump has an issue with him. Maybe Thune. Who knows? But of course,
Rick Scott
we'll bring it to you as soon as it happens right here on Bloomberg. If you want a little bit more insight on who they may pick, stick around. Joe and Kaylee up next on Balance of Power.